I went from gaining 30% per year on my investments to losing over $75,000 in 6 months. It wasn't easy. I invested every single paycheck for months, and somehow my net worth now is lower than it was a year ago. What's happening? Why is the market tanking? And what can you do about it? Well, let's get into it. Let me give a brief oversimplification of what's been happening in the market over the past 2 years. In 2020, the pandemic started. Everyone locked themselves in their bedrooms shut down, and the economy came to a halt. The market crashed. Stocks dropped over 26% in just 4 days, marking one of the biggest crashes in history. In response, the government did everything they could to prevent a recession or depression. They printed money. Every single person and their dead grandmother got a $1,000 check. And if that wasn't enough, they did it again. And again. In total, raising the amount of money circulating in the United States by over 35%. Many people were better off after the crash than before it. This prevented a recession, but it provided most of us with more cash that increased our savings rate by 2 to 3 times. We could now afford to buy more than before the pandemic, and we started spending more. Spending a lot. Companies increased their prices across the board because customers could pay for it. This, along with supply chain issues and the war in Ukraine, led to inflation. An 8.6% rise in the consumer price index is the most inflation we've seen since December of 1981. That's high. To stem inflation, the government is now raising the federal funds interest rate. With the rise of the federal funds rate, this means that you'll earn more in interest in a savings account, but it'll also cost more to borrow money. This should increase savings, limit spending, and damper inflation. But with decreased spending and inflation not yet under control, the next worry is a recession. Many people believe, if we're not already in one yet, that it's mere months away. And this is why the stock market is crashing, because of an impending recession. So, what can you do about it? The stock market is in a bear market. This means it's down more than 20% from its all-time highs. And since nearly all of my investments are in the stock market, this means my portfolio is also down about 20%, or over $75,000. As I've talked about previously, I wouldn't be investing unless I had a 3 to 6 month emergency fund and no bad debt. Since I have both of these out of the way, I can now focus on investing. So here's how I'm handling the impending recession. My rules of investing don't change based upon the market situation. Here's why. When I'm investing, I have 3 options. Invest now, invest in scheduled increments, say every 2 weeks, or invest whenever I see best fit. If I invest now, this would be considered lump sum investing. If I schedule my investments over time, this would be considered dollar cost averaging. I would be reducing my risk of markets ups and downs by investing over time. Many studies, including this one from Vanguard, show that lump sum investing beats dollar cost averaging over 70% of the time. I like those chances. And this study was performed over 90 years where recessions and depressions happened. Time in the market beats timing the market. So I invest now. The third option is investing when I best see fit, or market timing. Maybe I think the market will continue going down, so I'll hold off on buying certain investments, or even sell some. Maybe I have insider knowledge, or listen to experts like Jim Cramer, and know that even during a recession, people still use toothpaste and shampoo, so those companies will do better than others.
What companies have historically done well in a recession? Do you brush your teeth in a recession? Do you wash your hair if you have some in a recession? Absolutely.
Maybe I like the idea of actively managing my investments because I know when to buy and what to buy better than the average person. That would be stupid. Many studies, including this one from the School of Wharton, show that Jim Cramer consistently loses to the market. I could pay for his premium service that alerts me when to buy and sell certain stocks, but that would cost me way more than the service is even worth. Instead, I could opt for the best actively managed funds. I could look at which funds have done best over the past 5 to 10 years and let those managers make the decisions for me. With their experience, knowledge, and resources, their decisions would surely be better than mine. That would be stupid too. Actively managed funds can beat the stock market, but the chances are low. Say 30%. Try to beat the market over multiple years and the odds drop dramatically. Any fund beating the market is likely just luck. Given a few more years, most likely regression to the mean will prevail. So what do I do instead? I realize that no matter how much research I do, I just don't have the knowledge, information, or resources to beat the market. I don't know when to buy or when to sell, so I don't fight it. I buy low-cost, passive index funds that mirror the market. They perform exactly as the market does and beat money managers over 70% of the time. And I use Vanguard's target date funds as a guide to help diversify my portfolio. When recessions are hitting and markets are volatile, I continually revert back to this model for optimal diversification. At 30 years old, I maintain 90% of my investments in passive stock index funds as recommended by Vanguard. 7% is in bonds and about 3% is a small gamble within crypto. Although the market is crashing and a recession is impending, I just can't find evidence of a better strategy than this. So here are my final thoughts. The pandemic shut down the economy, leading to tons of pandemic aid. This caused increased spending and prices to rise. Inflation has taken over, the Fed is fighting it by increasing federal funds interest rate, and a recession is now looming as the market crashes. Despite all this, my rules of investing haven't changed. The evidence for investing hasn't changed. If I have money, I invest it now, even if it means potentially losing more money. I put those investments in low-cost, passive index funds that mirror Vanguard's retirement recommendations, even if that means stocks are now crashing. Until I find statistical evidence otherwise, these are my financial habits for health excellence. Thanks for stopping by, and if you're looking for more habits for health excellence, feel free to check out my weekly newsletter where I include the 3 most important things that I've read, watched, or listened to within the past week. Thanks again, and I look forward to seeing you guys next week.